Welcome! Today we are diving into a critical decision every entrepreneur faces: choosing the right business structure. Your choice impacts your taxes, your liability, operations, and more. So let's break it down. First is a sole proprietorship. A sole proprietorship is the simplest structure. It's ideal for small businesses or solo entrepreneurs. It's easy to set up and gives you complete control. However, there is no legal separation between you and your business, meaning you're personally liable for any debts or legal actions. This means that if your business incurs debt or is sued, your personal assets are at risk. Next is a partnership. A partnership involves two or more people sharing ownership. There are general partnerships where all partners manage the business and share liability, and there are also limited partnerships where some partners have limited involvement and liability. Partnerships are relatively easy to form and allow for shared decision making and resources. However, disagreements between partners can complicate operations and decision making, so having a clear partnership agreement is crucial. Next are limited liability companies. An LLC combines the flexibility of a partnership with the liability protection of a corporation. Owners are called members, and they're not personally liable for the company's debts, meaning their personal assets are generally protected. LLCs offer tax advantages, and profits and losses can be passed through to the members' personal income without facing corporate taxes. They're easier to manage than corporations, making them a popular choice for small to mid-sized businesses. Okay, next up are corporations. Corporations are more complex and suitable for larger businesses. There are two main types of corporations: a C corporation, which offers the strongest liability protection for owners but face double taxation. Profits are actually taxed at the corporate level, and dividends paid to the shareholders are taxed again at the individual level. With S corporations, you're able to avoid the double taxation by allowing the profits to be passed directly to the shareholder without being subject to that corporate tax. However, S corporations have ownership restrictions, such as a limit on the number of shareholders and who can actually be a shareholder. Corporations can also raise capital more easily by issuing stock, which can be a significant advantage for growth and expansion. Next are nonprofit organizations. If your goal is to operate for charitable, educational, or social purposes, consider a nonprofit organization. Nonprofits enjoy tax-exempt status, meaning they don't pay federal income taxes on donations and other income that are related to their exempt purposes. However, they must adhere to very strict regulations and reporting requirements to maintain their tax-exempt status. This structure is ideal for organizations focused on benefiting the public rather than generating a profit. Choosing the right structure depends on your business goals, the level of control you want, your liability comfort, and tax consideration. It's important to assess your current needs and future plans when making this decision. Obviously, consulting with a lawyer and a financial advisor will help provide you with personalized guidance tailored to your specific situation. Thanks so much for watching. I'll see you next time.